Welcome to the deep dive. Today, we're looking at, well, a really interesting take on the recent stock market wobbles. Instead of just focusing on the sell-off itself, we're going to dig into some potential opportunities that might be hiding in plain sight.
Right. And for this, we're leaning on a piece from the Motley Fool. They've zeroed in on three of the Magnificent Seven tech stocks.
Amazon, Alphabet, and Meta platforms, all of them down 20% or more from their highs.
Exactly. So the big question is, could this actually be a buying opportunity?
That's what we're exploring. We're using that Motley Fool article. It came out April 28th, 2025, titled Stock Market Sell-Off. 3 Magnificent 7 stocks down 20% or more to buy right now.
Yeah, and our mission really is to unpack the why behind their picks. We want to get past the noise about, tariff concerns hitting 2025 earnings, which the article calls kind of short-sighted.
Right.
And really understand the fundamental arguments for these 3 specific companies right now. For you, the listener, we're aiming to pull out the key insights without getting lost in the weeds.
Okay, let's jump right in then. Amazon first.
That's good.
So their stock's taken a significant hit, like we said, over 20% down. And the article makes an interesting point. Unlike Meta and Alphabet, Amazon's profit margins right now aren't, sky high.
Yeah, they're not.
Yeah.
Which leads to a higher PE ratio, currently sitting around 34.
And just quick reminder for listeners, PE is price to earnings, basically what investors pay per dollar of profit. So 34 might seem a bit steep on the surface.
It might, yeah. But this is where the fool's argument gets really interesting. They're essentially saying Amazon is on the cusp of a major profit expansion.
Over the next 5 years, they reckon.
That's the time frame they suggest. They think this coming surge in profitability is the real story and why this current dip could be a great entry point for the long haul.
Okay, so what's driving that expected profit jump? What are the mechanics?
Well, there are a few things. First, you've got the evolution of their e-commerce side. They've shifted more from selling their own stuff.
Right, holding inventory.
To acting more like a platform, managing transactions for third-party sellers. And that inherently carries higher potential margins.
Okay, makes sense. Less direct cost of goods sold.
Exactly. Then you add in these other really high-margin revenue streams that have just exploded. Advertising, for one.
That's huge now, isn't it?
Oh, yeah. We're talking $56 billion a year.
Yeah.
And subscription services, think Prime, music, etc. It's another $44 billion annually.
Wow. Okay, so you've got the core e-commerce becoming potentially more profitable, plus these massive high-margin ad and subscription businesses layered on top.
Precisely. And the article specifically mentioned the potential in their North American retail margins. They were, 6.4% in 2024?
Yeah.
The expectation is they could get over 10% in the coming years.
Okay.
And, of course, you absolutely cannot forget AWS, Amazon Web Services.
The cloud giant still printing money.
Pretty much. Over $100 billion in revenue. And its operating margin in 2024 was a really healthy 37%. It's a beast.
So bringing it all together, improving e-commerce, profits, strong AWS performance, plus ads and subscriptions.
It paints a picture of potentially massive future earnings. The Fool even throws out some numbers projecting maybe $750 billion in annual revenue.
Which is up quite a bit from last year's $638 billion.
Right. And if they hit, say, a 20% overall profit margin on that, you're looking at $150 billion in annual income.
And based on their current market cap, which is around $2 trillion.
That translates to a PE ratio of just 13.3.
13.3, that's a huge difference from the current 34.
It really is. It suggests a potential shift, from being valued purely as a growth stock to maybe more of a value play down the road if those earnings materialize.
So the takeaway for Amazon, according to this analysis, is don't just look at today's PE. Look at the potential for serious margin expansion in e-commerce and the continued dominance of AWS. That's what makes this dip potentially attractive long-term.
That sums up the Amazon case nicely. Ready to move to Alphabet.
Let's do it. Google's parent company. Also down significantly 21% off its high, the article says. And this is despite a recent earnings report that sounded pretty positive.
Yeah, that's the interesting part. The Fool's argument here really leans on Alphabet's continued strong business performance and some really exciting future growth drivers.
They mentioned the user base too, right? Suggesting maybe the largest daily user base globally across Search, YouTube, Google Cloud, though they admit the exact number isn't public.
It's hard to argue with that reach, isn't it?
So,
and if you look at the Q1 numbers they highlighted, search revenue up 10% year over year to $51 billion.
Solid.
YouTube ads also up 10% to nearly $9 billion. And Google Cloud, Really impressive growth there, up 28% to $12.3 billion.
And profitability improving too. I thought I saw something about margins.
You did. Operating margin expanded up from 32% to 34%. So they're getting more efficient even as they grow.
Okay, so the core businesses are humming along. What about the future stuff?
Well, they point to things like the advancements with their Gemini AI tools, which is obviously a huge focus area across tech right now,
Right, the AI race.
and also the really rapid growth of Waymo, their self-driving car unit.
Oh, yeah, the robotaxis. How are they doing?
Apparently, they hit 250,000 weekly rides. That's a 5-fold increase compared to the year before. So real momentum building there.
Huh, 5x. That's significant traction. So even with worries about AI competition, the core is strong, margins are improving, and you've got these potentially game-changing bets like Waymo scaling up.
Exactly. And then you factor in the valuation. The PE ratio is around 20.
Which is quite a bit lower than Amazon's current PE.
It is. So the argument is strong company, still innovating, core business growing, future bets look promising, and you can buy it at a PE of 20. That looks attractive for the long term.
Okay, clear case for Alphabet. Now, Meta platforms. Facebook, Instagram, WhatsApp, they've seen the biggest drop of the three, right? Down 26%.
Yeah, the steepest decline of this trio. And the Motley Fool's case for Meta really hinges on two main things. Its absolute dominance in social media, and again, its valuation now.
The dominance part is undeniable. They quote a number. 3.35 billion daily users globally if you exclude China.
It's staggering, isn't it? Over half the world's population outside China uses one of their platforms every day.
That kind of scale, it just creates this massive competitive moat, doesn't it?
It really does. I mean, who can realistically compete with that network effect in their advertising machine? Maybe TikTok in terms of time spent, but platforms like Snap or Pinterest just aren't in the same league scale-wise.
And their recent financials back this up.
Oh, absolutely. The article highlights their last quarter. Revenue grew 21% year over year to $48 billion. That's impressive growth for a company that size.
21% growth on that base is huge. What about profits?
Even better, arguably. Operating margin expanded significantly from 41% to 48%.
Wow, 48%.
Yeah, which meant operating income jumped 43% compared to the year before. Just really strong financial performance.
And like Alphabet, they're not just sitting back, are they? They're investing heavily in future tech.
That's a key part of the bull case. Zuckerberg is pushing hard into AI, virtual reality, mixed reality, the whole metaverse concept, essentially.
Right, the big bets on the next computing platform.
Exactly. And they're funding these massive R&D efforts while still maintaining that incredible 48% operating margin on the core business. It's quite something.
So dominant present, huge profits, funding ambitious bets on the future, and yet the stock is down 26%.
Precisely. Their trailing PE ratio has dropped to 22.
So similar PE to Alphabet, actually.
Pretty close, yeah. So the argument from the fool is, look past the short-term tariff jitters.
Yeah.
You've got unmatched scale, fantastic financials, big future bets, and a PE of 22. That looks like a compelling opportunity.
Okay, so across all three, Amazon, Alphabet, Meta, the common thread seems to be that the Motley Fool views these current market concerns, especially around tariffs impacting 2025, as sort of short-sighted.
That's the term they use, yeah. They see it as creating a window for long-term investors to buy into fundamentally strong businesses at a discount.
Now, we should definitely mention, as the article itself does, some potential conflicts of interest, right? Just for full transparency.
Absolutely essential. You need to be aware of this. The article discloses that several people connected to these companies are on the Motley Fool's board.
Like Suzanne Frey from Alphabet.
Randy Zuckerberg, Mark Zuckerberg's sister, and a former Facebook exec.
And John Mackey, former CEO of Whole Foods, which is owned by Amazon.
Right. Plus, the author of the piece holds shares in Alphabet and Amazon, and the Motley Fool itself recommends all three companies, plus Pinterest.
So it doesn't invalidate the analysis, but it's context you absolutely need to have when you're considering their perspective.
Definitely. Always consider the source and any potential biases.
Okay, so just to quickly recap this deep dive for everyone listening. The Motley Fool analysis highlights Amazon's big potential for profit growth from e-commerce margin expansion and AWS strength.
Then Alphabet's solid core business performance, improving margins, exciting innovation in AI and Waymo, all at a reasonable PE of 20.
And finally, Meta's sheer dominance in social media, its stellar financial results, its bold investments in future tech like VR and AI, combined with a PE of 22 after the sell-off.
And the overarching message is, maybe look beyond the immediate market worries about things like tariffs and focus on the long-term strength and potential of these tech giants.
It definitely gives you a different lens through which to view the current market volatility.
It does. And it leads to, I think, a really provocative thought for you to chew on. Given how interconnected these three companies are in, well, almost every facet of our digital lives,
E-commerce, cloud, search, social media, advertising.
AI, VR, autonomous driving, you name it, what might be the unforeseen consequences or maybe even synergies that could come from them all taking a hit around the same time and then potentially rebounding together?
Is buying into these dips, essentially, a concentrated bet not just on three individual companies, but on the entire future trajectory of the digital economy itself? Something to think about.